on this panel, Mr. Shankar Sharma. I'll just give a quick background. I think he needs no introduction, but I think it would be befitting to just give a, just a small brief. Mr. Sharma actually is an MBA from the Institute of Management, Manila, and he finished on the Dean's list with almost, in the top 10% of the class. After a brief stint in Citibank between 88 and 89, he quit and started First Global. Interestingly, First Global set out to globalize its operations very quickly, and right from 1999 onwards, he set out on this mission. And in 2000 and 2001, the company ended up getting its membership for the prestigious London Stock Exchange and also the NASD US to start trading in both these markets. Now, First Global built its research coverage of global companies and economies around the world. Its research independence, unbiased stance, and ability to discern trends ahead of the street have made its global reach gain tremendous following among institutional investors worldwide. Mr. Sharma heads the strategy group of First Global, and he has many market calls to his name, and wherein he actually predicted a number of the market moves right from the 2000 tech crash to even the 2008, the large global financial crisis that we had. Not only on markets, also on oil. I think some very, very good predictions between, buy call, on oil at $29 in 2016. In fact, prior to that, when oil was at 150, he gave a sell call. The other interesting part is also about his, his ability to identify stocks early. Not only Indian stocks like HDFC Bank and Bajaj Auto, Maruti, etc., but also global stocks like Amazon, Apple, Netflix, and Domino's. And he was one of the earlier identifiers. In fact, even in mid 2019, when the bull market was a little narrow, he ended up warning investors about it. So, Mr. Sharma, I welcome you, and I'm sure all of us look forward to a very informative session from you.
Thank you, Anil. It's a real privilege and matter of great joy for me to be here on this webinar. And as I understand, these are all attendees are from the beautiful city of Bangalore, which, of course, I go back to my early visits to Bangalore when Infosys was, I think, a company of maybe 1 or 2 crores of turnover when I first met Nandan, who continues to be a good friend, and that was, I think, in 92 or 93, something like that. I mean, definitely before 95. And at that point in time, nobody knew that Bangalore would become what it has become today, and that Infosys would become what it has become today. So that is the beauty of this business of investing, meeting people, meeting companies, identifying big trends, mega trends, or identifying a bunch of companies coming out of your beautiful city who have become dominant companies, in a short span of just about 15, 20 years. So, and which also therefore leads us to the big broader topic of our discussion today, which is looking beyond India in terms of our investment mindset, thinking, footprint. And again, I bring you back to the example of Infosys, that Infosys, had it just continued to think it was a domestic IT services company, servicing Indian companies, Indian businesses, doing their sort of IT outsourcing, would it have become Infosys? Obviously not. We all know that. And to the credit of the founders of Infosys, they thought global right from the very beginning. And they said that, look, in order for us to really build a large-scale business which is sustainable, which is also diversified, which is also de-risked, as well as having good margins, we have to look beyond the shores of India. And look, that decision, not just for Infosys, but the entire IT outsourcing industry, turned out to be absolutely game-changing, which is exactly what our learning at First Global has been. That when we started our careers, and I was lucky in a lot of senses that when I decided to leave Citibank, when I did my MBA, obviously all MBAs think of coming and working for a bank body or for an FMCG company, and I was no different. The only difference was I was very clear in my mind that I did not want to work for a bank beyond 3 years. It was literally like a straight line vision that I saw back in the late 80s, that India at some point in the future would become a significant financial market. And if I got in early, I stood to ride the entire boom of, Indian stock markets becoming significant parts of the world, the world becoming more interested in India. It was just, you can call it just a straight line vision. I don't know because of what reason, what rational thought, but it happened. And as a result of that, I decided to come and work for Citibank and then leave and start off on my own. I thought initially I would work for 3 years and then leave and start FG. But in 1.5 years, I thought that I figured out that I had learned all that I wanted to learn or I could learn at Citi, and it was about time that I quit and I decided to go out on my own. I was just 26 at that time. And in hindsight, it was a bit of foolishness, a bit of madness to make those decisions, because at that time there was no VC capital, backing young, bright kids. You just had your own money, and I didn't have any money at all. I had just I think 5,000-10,000 rupees, which was my provident fund that I withdrew from Citibank. And I said, all right, let's go out there and we'll see, how good or how bad I am. Of course, it's a very tough journey for the first 2-3 years, because without money, you really struggle to make ends meet. And of course, in the middle, one big seminal change that happened, which has changed all our lives, all the people on this call have been changed because of that 1991 budget of Dr. Manmohan Singh, which came at the time of great crisis for India. And, it was a very, very far-sighted, far-reaching set of policies that were announced by Dr. Manmohan Singh, which opened up India to foreign capital, opened up Indian stock markets to FPI and FII investors. And that, in hindsight, for me personally and for FG as a company, was game-changing. That here you were a kid of 26, 27, and a big reform like that happens when suddenly the Indian markets are opened and huge amounts of foreign capital start to flow in. And at that precise time, when we looked around, when we looked at the other brokerage firms, they were all the traditional old line firms who had become members of the Bombay Stock Exchange. NSE had not even been formed then, by the way. SEBI didn't exist back then. I mean, imagine those are the really early days of the evolution of Indian financial markets. So the old guys were all fat. They had made a lot of money by charging commissions of 2%, even 5% on a single transaction. And they were not hungry enough. And, we were young kids, we were hungry. We had no option but to be hungry, right? That we had to only think forward. We could not go back to a job. And then this whole slew of capital came in. And then we built our research. We said, all right, so the old guys don't have research. There's all tips and following up this management, insider trading, all the kind of rubbish that was going on. And we said, now this is a great opportunity for us to build a crack research team. We go out to the world, we market the India story, we attract a lot of capital. And because we are professional, we are educated, we know what financial analysis is all about, more monies will come through us than through the old line brokers who had become members in 1950 or even in 1900s. And that turned out to be absolutely a prescient thinking, because when we started to research companies, in fact, I mean, I remember, calling up with the Sundaram group in Chennai, and they would say, what is stock research? What is analysis? Just your annual report. I mean, that's all. We don't want to meet anybody. I mean, what is all this company meetings and, you're calling up, asking for investor relations? We have no such thing. And there were all kinds of, people, would bang the phone down on you. Management wouldn't want to meet you. Forget about plant visits and all, that was never heard of. We even had to go and camp outside their cabins, outside their offices, that when the boss comes, you will waylay them and say, sir, we want half an hour to understand your business. It was really, very, very interesting times in the journey towards, where we have reached right now in terms of India, the level of disclosure and the transparency. So uh, when we started doing that, and we started getting exposed to lots and lots of foreign investors who were far more sophisticated than the Indian mutual funds which existed at that point in time. And there were a few, so there was UTI, and then there was SBI, and the private sector mutual funds had just kind of started. So Zurich Mutual Fund was there, and a handful of others. We found a distinct difference in the quality of analysis, quality of thought, quality of ability to see things in more clear light in the foreign investors as compared to our domestic fund managers. It was a huge difference. In part, it was also because of the fact that the Indian markets had been closed, so Indians were not really very sophisticated in terms of their understanding of businesses or companies. There's not enough history to go by. I can understand all that. But it was also that the foreigners brought a degree of rigor in research, rigor in analysis, which really we Indians, at least at that point in time, did not have. They taught us, in fact, a lot of our clients taught us so many tools of research, so many tools of analysis, because they had been investing globally. They had been investing in the US, they had been investing in Latin America, investing in other parts of Asia, investing in continental Europe, UK. They gave us, we were students, while they were clients, we would sit with them after the business meeting, and we would ask them, like kids in a classroom, the teachers, tell us what else we can do, how else to look at businesses, how else to look at companies. It was literally a journey of learning. And throughout the journey, many clients, and again, investing is not like somebody knows 100% and somebody doesn't know anything. It's everybody knows a bit, some a bit more, some a bit less. We all are humble. We learn, we just keep asking questions. We may not have all the answers. So we kept asking questions, we kept getting answers. The questions and answers became one whole mass of learning. And then as a result of this, we started to think at FG that now we know a decent amount of research, decent amount of analysis. Why just stick to India? Why can we not think global? Why can we not think like what Nandan Nilekani and Naran Murthy thought? That why just stick to India? If you have skills, if you have knowledge, if you have the capabilities, why just play in a small pond? Why not expand the pond? Why not take this abroad? That was a seminal change in our thinking. Also, a very important thing, the 97-98 Asian crisis. Okay, I don't know how many people on this call remember that, but that was like the COVID crisis that we are seeing right now. I mean, it was horrifying. It was terrible. It was for me the first real crisis I had seen in my sort of professional career. It was, currencies were falling 10% a day. The Indonesian rupiah or the Thai baht, I mean, you name it, they were getting crushed. I mean, I think at one point the rupiah, Indonesian rupiah was down, I think 90%. Even the Hong Kong dollar, while it's a peg currency, came under a lot of pressure, that the peg would break. It was absolute mayhem, absolute and total mayhem in markets. And we were sitting there in our offices, and Devina, my wife, who's from Ahmedabad, very accomplished lady, and she was my colleague in city also. We are sitting there and we are saying, and the markets are plunging. They are like one way down. Currencies are collapsing. I mean, the whole Asia story looked like it was over, right? And we are sitting there in our cabin. We are saying that what happens if this whole thing collapses? What happens if India collapses, or these great countries, Taiwan was collapsing, South Korea was collapsing, Thailand was collapsing, Indonesia was collapsing, Singapore was collapsing, Hong Kong was collapsing. We said, I mean, India is hardly as strong an economy as these countries. I mean, these are collapsing. Maybe even India can collapse one day. And if all our business, all our income is sitting in, and all our assets is sitting in one single market, and that collapses, it's suddenly game over. Your life is over. All that you've earned is suddenly vanished, evaporated. That was like a light bulb going off. It just said, man, we need to diversify. We need to just get out of this single country, single currency, single asset risk, which we have called it the term SCARS, which is SCCARS, single currency, single country, single asset risk. So all of us, all our capital was in India, all our capital was in equities, and all our assets were sitting in a single currency called the Indian rupee. That for us, apart from the fact that we by that time we had become very accomplished, reasonably accomplished, not very, as analysts, as people who understood many things about research, how markets work, how investing work, and then coupled with this shock, just opened up our thinking that we need to get out. We need to build global capabilities. We need to diversify out of our single country, single asset, single currency risk. So in that journey, then we first became members of the London Stock Exchange, and we became members of the NASDAQ. And we then started the whole process of researching global companies. And believe you me, that decision, one decision, has changed our lives. 22 years on, I can tell you, I mean, life you take many decisions. So one decision, of course, was, for me to leave Citi, start out on this business. I was 26, Manmohan Singh liberalized the economy. It was pure luck that I was 26, my prime earning years were ahead of me, and a huge reform like this happened. Both came together, and I had no idea what Manmohan Singh was going to do, right? I just quit. But sometimes the universe finds ways to reward you if you take some brave decisions, not always, but sometimes. That was one. And the second was the decision to globalize and diversify across countries. It just has been a beautiful journey. I cannot even begin to tell you how rewarding it has been, both financially and intellectually. It has been a dream run. And the dream started from the time when and by the time we started, the whole dot-com bust happened, which was great, because when a crisis happens, then that's where the opportunities come. And when the crisis happened, all kinds of companies collapsed. They collapsed in India. We all know the whole tech sector went, a lot of companies went out of business. In the US also, lots of companies went out of business. And then we started, in the whole debris and the rubble of this collapse, we started to see what could we get out of this. And that's when we came across this company called Amazon. It had been listed, I think, from 96. It had been losing money consistently. We had been researching the stock, covering the stock from 2000 onwards. In 2001, Morgan Stanley wrote a piece of research saying that we are throwing in the towel on Amazon. This is it. They are not going to survive. This company is going to go bust. This report was written by Mary Meeker, who had been the champion of the whole internet economy, Internet 1.0. That was Mary Meeker's, big calling that, the world is going to change because of internet, etc., which it did. But she got the stocks completely wrong. And at the price of $11 or $10, she wrote a big report on Amazon saying, throwing in the towel on Amazon. So we are sitting in office and we are looking at the numbers, and our analyst who covered Amazon, walks into our cabin and says, sir, I need a couple of minutes with you. I said, all right. And he said that, look, everybody's saying Amazon is going bankrupt, right? But here is the number, here is the data, that in this quarter, okay, they have for the first time in their history turned in free cash flow positive, and not just positive minorly, but $144 or $145 million of free cash flow, which on an annual basis then becomes, $600, $650, $700 million of free cash. So Dana and I said, are you serious? I mean, everybody is saying this company is going to go bankrupt. He said, my arithmetic is right, but I think we should write to the company and confirm, get a confirmation from the management. So we wrote a letter to the Amazon management, to Jeff Bezos and to his CFO. And we said that, look, we want to get onto a call with you guys and understand your financials. We don't want any forward-looking statements, but we just want to understand your free cash numbers. They said, all right. So Bezos and I think his CFO, some Warren something, came onto the call. We showed them our numbers and asked them, are our numbers wrong? Or are they correct? And they said, no, your numbers are correct. So I asked Bezos, you're actually free cash positive, $145 million. He said, yes. He said, all right, great. Thank you very much. Bye. And then Bezos sent us a mail just after the call saying that thank you for the support, guys, because we were the only firm on Wall Street which actually put out a buy on Amazon at that point in time, which was completely contrary to what the entire street was betting on, that the company would bust. And of course, fortunately, at some point, a little bit down the road, we bought some personal stock as well. I mean, that is now up to 250 times since then. Again, you would say, what was so difficult? It's not difficult. It was common sense based on very, very detailed research. But at the end of it, it came down to a number which nobody on Wall Street was looking at. And exactly the same story got repeated in Apple about a year later in 2002. Similar things. Again, Wall Street overlooking very obvious signs. I mean, Amazon has been very rewarding, but Apple was rewarding to a pretty large extent. I mean, we made, I think, 70, 80x on Apple. Along from that time onwards, not just US stocks, but stocks across the world, we have not just become rich financially. That's fine. I mean, I didn't get into the business to become only rich. I mean, that was a byproduct. I just wanted to do this. I just love what I do. The money is a byproduct. It was more the enrichment of finding great companies across the world, applying your skills to not just India, because, an HDFC bank is something. I mean, I have known HDFC Bank. I've known Aditya Puri for the last 35 years. I was a kid when I joined the bank. I worked with him. I have known him personally. I don't need to research HDFC Bank. I mean, at the time it was listed, it listed at 30 rupees. We were the only company that put out a buy on HDFC Bank when the stock listed at 30 rupees. And our research report had the picture of a baby on the cover and then an arrow showing Arnold Schwarzenegger. And we said, this is the baby right now, but this is where it is going to go. Was that not right? Did it not become Arnold Schwarzenegger? So, to research Indian companies, we know that like the back of our hand. I mean, a Bajaj Auto we've known for 30 years, or a, ACC or Ambuja Cement, or, Reliance, or, all these banks, or the petrochemical companies, Tata Steel we have known for, 25, 28 years. I mean, there is no additional thrill we get out of doing this. Bharti, Sunil Mittal has been a close friend from 92, 93. I mean, we know these companies, we know the management, we know the promoters. Doing India for us is literally a half an hour per day job. Okay. And by the way, over the period of years, we again realized that we have to change up the game. So over time, we become extremely quantitative in our approach, extremely data-driven in our approach instead of the traditional side of money management. And the more the data you use, the better you are as a fund manager, which distinguishes us from the rest of the providers of PMS or whatever other structures are there. We are completely data-driven. The man plus machine model is the future of investing. The whole traditional model of going and finding a company and talking to management and then figuring out things is something which is a hit or a miss. And over time, we have moved away from the old style to what is now the future of fund management, investment management. So, as I said, doing India for us is easy. It's a piece of cake. Our PMS is the best performing PMS this year by far. We avoided the downfall of February, March. We got back on April 1st. We have ridden the rally, pretty well. Doing India is no big deal, frankly speaking. I mean, from our perspective, it's difficult for most of the people in this business, but having done this for 30 years, we don't find that, it is a great thing to do, but the intellectual satisfaction, because that for me is very important for us as a firm, very important, comes more from the global part of what we do. And I will talk about that a bit, and then I will talk about, where India is in the whole scheme of things. So, like I said, we've had great wins like Shopify we picked in 2016 in the US. It's up, I think 30 or 35 times. Just in this downfall itself, in our global funds, okay, again, we sidestepped. We were down only some 7 or 8% in the month of March versus a 30% down for the US markets and practically all markets. And then on March 21st, we went back into the global markets. From there, it's been a home run, absolute and total home run. We have, for example, we picked DocuSign at about, I think, $75. Yesterday, it closed at 155. And by the way, it's not just about US stocks. So I'm coming to the next point, which is globalization does not mean just going and buying US, because that is as dangerous as just remaining in India. The point is, and I will share some data with you, not in this call because it's the Saturday and I don't have access to all my documents, but I'll share it with Anil and he can share it with all of you. Every year, practically, if you look at the performance of all markets globally, the leadership keeps changing. So, for example, last year, 2019, global markets did very well. India did extremely poorly. India was, I think, 9 or 10% up, which was right at the bottom of the table. Right at the top was not the NASDAQ. It was Russia. Russia was up nearly 50%. The NASDAQ was somewhere in the low 30s. S&P was, I think, high 20s. But Portugal, Spain, Italy, they were all 25, 30, 32% up. The continental Europe markets were up 30%. I'm talking all in dollar terms. So people say NASDAQ. I say, hey, slow down. That is very, very dangerous. The whole point of going outside India and you're investing is not to go and buy another market, single market, and then the NASDAQ tanks, as it does. That's the nature of any market. Then you're suddenly saying, hey, why did I come out of India? That's the point. You cannot leave India and then go to just one more market. The whole point is leadership keeps changing. And therefore, a dynamic approach is required. You can't just go and buy one country and say that I have done my diversification globally. That is going to lead you to a bigger disaster than just remaining in India. So I will share that data. It's an eye-opener. Some year, Brazil, tops the chart. Some year India tops the chart. Some year NASDAQ tops the chart. Some year, Switzerland does very well. Markets keep changing. It's never a constant. And which is where the whole skill of investment management comes in. That does the investment manager understand global macro? Has he done it for long enough? Are they capable of managing the global risk spectrum? If the answer is yes, then please diversify. Otherwise, just don't go and buy a country fund or a feeder fund or an ETF, because that ultimately, on the next webinar, you will tell me that why did you ask us to diversify? Because we were just, crushed by that. To just give you a sense of perspective, the NASDAQ did phenomenally well. 99, 2000 crashed. 2003 finished. After that, emerging markets took off. So it basically became an emerging market trade from 2003-4. It just became India, Brazil, China, Russia, the BRIC Pact, Indonesia. That carried on till 2010. And then emerging started to fall. Other markets started to come up. Continental started to do well. US started to do well. And now everybody talks NASDAQ. I'm saying, hey guys, slow down. The moment you start talking so much about this, the trend will change. So the point is, global diversification has to be done. If you have all your assets in a single market, whatever the market is, and I say this even to US investors, who are only in the US, the guys, you need to think outside. There are lots and lots of opportunities outside. Forget about just the US. For example, we bought JD.com, which is, a large Chinese e-commerce player. $35, $37. Yesterday, I think $55, $60. We find opportunities across the world. So if we look at the composition, and by the way, we are amongst the top, if not the top performing, long only structure, this year, even on the global side. In India, of course, we are there. We are up, between 3 and 9% on our PMST. But even globally, we are up now for the year, simply because we avoided most of the damage of February, March. And we got into the market, tactically. The other thing is, again, when you think of going out, we cannot just do equities because there are tons of opportunities in fixed income. Tons and tons of opportunities in fixed income. For example, we bought the BPCL bonds, on the global side. It was trading at 85, 86 in the month of March. Yesterday, it was 101. Think about it. In a bond, that's like a return of nearly 15, 16%. So the world is full of opportunities. It's like a wash in opportunities. So we cannot remain narrow. Just as Nandan Nilekani and Narayan Murthy did not remain narrow on India. I'm Indian, I have to do only India. That is very, very old-fashioned thinking. We are investors. We need to allocate capital across the world. We need to allocate it across markets, across assets, across currencies, so that we are not exposed to any one particular single country, single currency, single asset risk. That is the mantra of investing that we have worked with, richly rewarded. We deal with, institutions managing literally hundreds of billions of dollars across the world. We've done this for a very long time. And the reason why we decided to actually offer it to people at large was basically that we said, why should Indians be deprived of this skill that an Indian sitting in India over the last 25 years as a firm we have built? Let that skill be available to people at large. Why should it be only available to the money bags and the people, who have 5, 10, 20, 100, 200 billion dollars? Let it be available to people at large. I don't need to do this for money. God has given me, more than perhaps what I deserve or what I, deserve to earn. The point is that this huge opportunity needs to be told to people. And when you look at your investment pie chart, 1 or 2 years down the road, when you see that you are so beautifully diversified, one slice is, in global fixed income, one slice is in, global investment grade bonds, one slice is in global emerging market bonds, one slice is in tech, one slice is in, traditional company. I mean, when you see that, you will feel good, because nothing then can destroy your life investment in a sudden crisis. And don't tell me crises don't come. We have seen one crisis coming, people's livelihoods have been wiped out. We need to protect ourselves against such kind of events by keeping our investments diversified. And anybody who tells you don't diversify is fooling you. Again, it is my personal experience. Diversification actually increases returns. It reduces risk. It gives you the best of both worlds. Anybody tells you, buy 5 stocks and you'll be happy. That's a recipe for disaster. Never ever do that, because you don't know whether the 5 are going to work, they're not going to work, which can collapse. So the same principle applies on a broad basis. Please diversify globally, but it has to be done right, because leadership changes. Just buying a feeder fund or a country fund is not going to be the solution, because you'll be exposed to the same risk in another country. It has to be done tactically. We need to be diversified across asset classes, some emerging, some investment grade, some US, some European. The stocks need to be mixed. You can't buy only tech and say that, okay, tech is making money, tech can collapse overnight also. We've seen that many times. So that's the whole message I want to carry here. Now let us come to what the market scenario looks like, because I'll take 5 minutes over this and then we'll open up for questions. First and foremost, let me make it very clear. I do not think there is a bear market in global equities. Okay? I do not think it's a bear market at all. It is nothing but a correction in a pretty significant bull market in global equities. And you have seen that play out. By the way, I will also share a WhatsApp chat I had with a hedge fund manager in the US in the month of March. When he asked me that, what do you think? And I said, market is going to make a new high within 3 months. Okay. And he said, you certainly are joking. And I said, you take it from me. I'm not joking. The market will make a new high within 3 months. Guess what? The market made a new high, right? US made a new high. So that's the point, that it is not a bear market for certain parts of the world. For other parts of the world, there is a problem situation. And the 2008 crisis was a crisis which was very uniform in terms of the overall fall in markets. So it was broadly 50, 60, 65% down for all global markets. This year, it has not been the same. So even in the month of April, if you see, markets had been very patchy, meaning at the bottom was India, Brazil, uh, Indonesia, South Africa. At the top, obviously, US did very well, but it's not only the US. Switzerland did very well. We've had Swiss companies in our global portfolios. China did quite well. I mean, Chinese companies, NetEase did very well, JD did very well, Baba did well. And then you had Taiwan doing very well. And, 3, 4 other countries. So markets this year have distinguished between countries which will come out of this crisis very strong and countries which will struggle to come out of this crisis. And unfortunately, the markets have said that India has a problem, which is why the Indian markets, while they have rallied from the bottom, it has actually not rallied as much as global equity indices have. It has actually underperformed the rally. And the reason for that is, we all of us know the data that the economy is down big time. Okay, estimates vary, but definitely this year we're looking at a GDP contraction. April and May are definitely minus 25 to minus 50% GDP, that kind of number. And overall for the year, we might contract 5%, maybe 10%, nobody knows. But more than that, the cases are still climbing rapidly. So it's not that the curve has been flattened, it's actually still a very upward trending curve, which only can mean that the pressure on the economy will continue. People will be scared to go out. People will not be, and of course, Bangalore has done very well. So you're not in the same camp as us people in Bombay, where it is a real problem, as well as Delhi, significant problem, Ahmedabad, significant problem. So markets are saying, global markets are saying that countries which have weak healthcare systems and therefore are not going to be able to cope with the flood of cases, and also countries which are structurally and fiscally stressed, India belongs to that camp, are going to have a tougher time coming out of this than countries which are, from a balance sheet perspective and healthcare perspective, stronger. So this year so far has been a night and day scenario across markets, unlike 2008, where it was very, very evenly spread. Almost all markets fell equally. So the outlook on India is very simple. India as a stock market is different from India as an economy, and it's about time that all of us started to think of the stock market not as a barometer of the economy, but it is actually a barometer of economic power of companies, of certain companies. Every crisis, 2008, now 2020, is leading to the decimation of companies in a certain sector, leaving only 1 or 2, 4, 5 companies surviving. Okay, that becomes a stock market. Stock market is no longer representative of the larger economy. It's just a representation of a handful of companies. So people say, why is the stock market rising if the economy is hurting? And I say, it's not. The stock market has nothing to do with the economy at all. It's just a barometer of economic of concentration of economic power. And that's also true elsewhere. So the fact of the matter is, Indian stock market will do fine. It will not be a roaring stock market. You're not going to get a roaring bull market, but we will get enough stocks to make significant money in. Okay. Will that be enough? No. We will make much more money abroad with far lower risk. So what, therefore, as an investor should you do? Obviously, most of you will have wealth only in India. It's about time that you diversify at least 25-30% of your wealth globally. It's done very, very easily. We have products there. You can do that in a matter of days. When you do that, you have got 30% abroad, then, and obviously 50-70% here. You have then a pie chart which is looking reasonable. Over time, this pie chart again needs to shift when you have half and half. Half is in India, half is globally diversified. Then you can sit and relax peacefully that I'm not overexposed to the risk of scars, single country, single currency, single asset risk. And we are there to help you through this journey. This is something we have done for a very long time. And we'll be happy to help all of you achieve the goal of lowering risk while increasing returns. And we are a conservative set of people. We are not aggressive high risk takers, because our learning is actually that is very silly. You don't need to take high risk to make money in the stock markets. And that is the way we do this whole process. We are never exposed massively to one stock or one asset or one industry. That's not us. We balance it out. It's a very, very scientific, rigorous process. It is not a process of stories and my personal belief and my personal convictions and my personal biases. When we do it the way we do it, you get, really speaking, higher returns with lower risk. And that is what our promise is. That is what our whole process is about. And we always deliver. We delivered it for a very long time for people with literally trillions of dollars of aggregate wealth. And we will do it for even all the people watching this. Oh, with this, I'd like to close my part of it, and I'm happy to take questions.
Yes, Shankar, thank you for your perspectives, and I think it has enriched all of us. Both the chat as well as the Q&A are flooded with questions for you. And what I'm trying to do is to, put them into segments so that, we follow a bit of a train of thought, right? And so let me start off quickly first with the global side. And I think, there are questions around the US stocks, some of them saying, how do I invest? Is it a good thing to invest? At least one person has said, I think US stocks have peaked. Okay, so what is your perspective of, let's say, the US markets and US stocks specifically?
So again, I mean, we are optimistic on several markets. US is one of them. As I am again repeating, please do not get fixated on only one market. I'm requesting you, I'm begging you, please do not just think US is the be all and end all. From 2003 to 2010, nobody cared about the US. Nobody. Everybody said emerging market. That's the only place to be. It is when we start thinking like this that we get killed in the markets. So US market is good. Certain US companies are good. Certain US sectors are good. We have, in our global funds, we have about 52% in the US, but the rest is outside. So it's very, very well diversified. US, I think, will do well, and there are other countries which we will. I mean, for example, in the last month, Brazil is up 50%, which we have in our portfolios. 50%. Is the US up 50%? No, it's not. So that's the point, that there are many opportunities beyond the US. US is good, but there are other countries, other markets, other stocks that are also good. And our approach is not a single market approach at all.
Thank you. In fact, when we were looking for a product for our clients, on a global basis, I think that was one of our thesis to look at, not just US, but also which can flip beyond US, because at some point there's, a tipping point that comes in. So coming to the second question, series of questions around, the Fed intervention, also, the global central banks interventions, etc. And one is, yes, there could be some sort of a push in the short term. One is, what is your view on that? But more importantly, what are the impacts also, for 1 year, 3 year, 5 years, slightly longish term, of some of these interventions?
So the biggest thing that changes as a result of not just the Fed, but there are other central banks in a coordinated fashion have obviously flooded the market with a lot of money, cheap money. All of that ultimately for us as investors is great news. Okay, what it does to the world at large is a larger question to which, frankly, nobody has the answer. Okay? I don't have the answer. I can't see 10 years out and say, this is what is going to happen. Nobody in this world can say. What we can see is that when you lower the cost of capital so dramatically, automatically you give a boost to asset prices. Okay, it's pretty commonsensical financial theory. And we are there in the business to make money as investors. The central bankers have a problem to figure out. Let them figure it out. We can't solve their problems for them. They have given us a solution. We will write that solution. And we are writing that solution. But to say that, how do they exit from these unconventional monetary policies? Who knows? US did an exit, so we know the QE was tapered in 2013. US will make attempts. Let things normalize. We're just 3 months into this crisis. I think we should have this conversation 2 years down the road to see what actions did the central banks take. So the first real unwinding of the unconventional monetary policies, even fiscal policies, actually happened in 2013, which was like 4 or 5 years after the crisis. So let some time pass. Only things will become clearer after that. We are still right in the middle of this.
Yeah, the other questions have come around, how do investors actually participate globally? One is there are a number of Indian ETFs. Is that the best way? Or, what else, how would you suggest that they participate?
So it's very, very simple. As I said, ETFs are extremely risky because they are giving you exposure to broadly one market, which is the US. And that is a recipe for disaster. What we created is a product for both small investors and large investors. So we have a global portfolio management scheme which starts at $10,000 only. It's 7.5 lakh rupees. It's a very, very small ticket, and that goes up to $99,000. You can invest within a matter of 2 days through your normal bank account through the liberalized remittance scheme. It's a very straightforward process. Onboarding is very quick. If you have your KYC in place, we have done it in literally 1 day. So that is a product meant for relatively smaller investors because they are segregated accounts. If you're a large investor above $100,000, we have a fund. It's called the Global Freedom Fund, where $100,000 and above, again done through the LRS route itself, and there are NRIs also who then are not bound by LRS and all that, they can invest any amounts of money. That is meant for people with larger ticket sizes, because when you come into a fund, there are many, many advantages that a fund structure offers over a segregated account. I mean, for example, I'm not to say that the PMS is doing very, very well. I mean, as I said, that investors are very happy, but simply that the diversification becomes a little bit, less easy in a smaller account. I mean, just to give an example, if you have a $10,000, $20,000 PMS with us, buying Amazon is a little bit of a challenge because it's a single share, $2,500. Then you look for fractional shares which are not liquid and all that. So if I buy in a $10,000 account a single share, $2,500, that's 25%, right? So therefore, as I said, but of course there are many stocks that you can buy in that, and the life is beyond Amazon. We have found amazing number of stocks, not just in the US but elsewhere. So it's a good portfolio in the PMS side. And for larger investors, the Global Freedom Fund, the GFF, is a terrific product. So this is called GMAP. The PMS is called GMAP, Global Multi-Asset Portfolio Management Scheme, that GMAP, and the Global Freedom Fund, GFF, is a proper fund. And both of them have a multi-asset approach. So right now, as we speak, our equity exposure, by the way, I must tell you this. So in February, we cut our equity exposure down to only 10%. We went into fixed income to 80%, global fixed income, which is one of the reasons why we avoided the big crash that happened in terms of the damage. Okay, because we sensed trouble in the 3rd week of February. So we moved into US Treasuries, we moved into investment grade bonds, while investment grade still fell, but it obviously didn't fall as much as stock markets did. So we avoided that. But on March 21st, we cut our fixed income, went back into equities. Today, as we speak right now, we have 84% in equities, diversified globally. And the balance is in fixed income, which is divided between US investment grade, certain very good emerging market bonds, and some part of it is in oil, some part of it is in gold. Oil we bought, just so that you know, on April 29th, when it was trading at about $16, $17. It has doubled since then. So we have a 2.5% allocation to oil. We have about 4-5% to gold. We have about 10% to fixed income, out of which it is divided again 3%, etc. And then 82% is in equities. So it's a very, very well constructed basket with representation from every asset class. No high degree of exposure to a single sector, or there's no such thing. So as I said, GMAP for smaller ticket sizes, $10,000, $20,000, $50,000, $100,000 and above, I strongly recommend the Global Freedom Funds. Both of them are very easy to do. We can get that, both of them set up within 2 days to 7 days.
Yeah, thank you. And in fact, one of the persons who also introduced us, or I think it connected when he was also looking out for global options, is a customer, Rajesh, and he's just onboarding on GFF. And his point is, what's your outlook? A quick one there.
Outlook is good. As I said, we are extremely bullish on global equities. we are extremely bullish on India in terms of the equities we own. So we own some very good names in India. We continue to like them. Uh, and again, our approach is a very flexible approach. We don't have big biases towards X company and Y company. So in India, we didn't own certain stocks in the month of March or April, which we own now. So we are optimistic on the India piece insofar as our portfolios are concerned. India will not be a broad bull market because still the real economy is hurting, and that nobody can deny that, right? We can't close our eyes to reality. But there are spaces in India to make money. Outlook is good on certain chosen sectors and stocks. Globally, is far, far more bullish, which is why I'm saying please diversify at least 30% to begin with. You will eventually find that even going beyond that is far more advisable than remaining only 100% in India.
Yeah, the other question from Errol, who's a very shrewd investor, and we do a lot of learning from him as well. I mean, he has a few questions for you, and one of them is, every bear market, the leadership, bear and bull market, you'll find that when the transition happens, the leadership changes, right? So, besides pharma, which are the sectors which you expect to do well?
So, in India, are you talking about India?
Yeah. Now I've come down to India, so I think the series of questions will be mainly focused on India. Sorry. Yeah.
So in India, of course, pharma was an underperformer. It changed. It has done very well in the last 2-3 months. So we have had significant exposure to pharma in our portfolios here. And then of course we all know telecom is doing well. But again, please don't take it as a recommendation. I'm very hesitant to talk about all these things because world is dynamic, things change. Okay, so don't come back and tell me you told me telecom and telecom has fallen because the government has set price tariffs need to be made 50% lower. So things can happen. It's a dangerous sector. It has been dangerous for the last 13 years. So just as a caveat, I want to say this is our view right now. It's subject to change, and it does change. So these are the sectors. We've liked chemicals for a very long time. We continue to like them, and we've had pretty good runs in that. So it's become a pretty narrow set of likes and dislikes. But the interesting thing that is happening in India is that some of the erstwhile very loved stocks are beginning to falter. I will not name them, but most smart people will figure it out. And as I said, when something becomes very popular, and which is again I'm saying, even globally, if people talk only Nasdaq or so, only X or Y, become careful because markets have a way of surprising us. So even in India, in the last 12 months or 14 months, a group of stocks became extremely popular. People just said, buy only this and forget about everything else. And we have started to see those same stocks begin to falter April, May, and into June. And that's the point. We remain very open. We remain very flexible. We go with the data. We are not biased or fixed in our thinking. So all my views are as of right now. Just please remember that. So we like pharma, we like telecom, we like chemicals, we like certain other stocks as well. And they've done very well for us. For example, we own a company in our PMS, which in this quarter is up 100%. Okay, I will not name it, but it delivered phenomenal returns. So, I mean, there are enough pockets of opportunities that we see in between small, mid, and large stocks.
Follow-up question on metals, Shankar.
So we like metals. We have actually bought some metal stocks in India also in our portfolio. Again, with the caveat that this is our view as of today. Things change, we will change. So we like to say that we are neither bulls nor bears, we are hares. So if we see danger, we will change. So as of right now, our outlook is quite okay. One of the other reasons is the dollar has weakened against many currencies, and usually when the dollar weakens, it's a good time for commodities. Okay, which is one of the reasons why we actually bought oil. And it's given us 100%. So we like the metal place as of right now, and we have some exposure in our PMS.
Questions on gold?
View on gold?
Yeah.
Yeah, we like gold. I mean, we have held it now for, I think, a couple of years. At least in India, it has beaten equities by a wide margin. Even this year, it has delivered far, far better returns. I mean, I think it's like a 50% outperformance compared to equities. Equities are down 20, it's up, I don't know, maybe 15, 20%. We like gold. So in our India PMSs, we have gold. In our global funds and PMSs, we have gold.
This is another question from Errol, and I'll read it in toto. Okay. Uh, Good morning, Mr. Sharma. In the past, you had famously mentioned that the lending business is doomed to fail, though it's the second oldest profession. Okay, yet HDFC and Kotak have given us the best CAGR amongst the nifty companies. What do you make of Bajaj Finance now?
Yeah, so I mean, when I say that lending business is a terrible business, that is by and large the case. But in every terrible business, you will find one or two winners. That actually proves the point that it is a terrible business. IT services, almost everybody won. I mean, before Satyam happened, okay, every IT company did well. I mean, if you hadn't bought Infosys, you had bought Wipro, or you bought, TCS upon listing, or a Satyam, more or less you made similar money because the sector itself was and still is a decent sector. Banking is it's a crap business. This is my business. It's a crap business. But in a crap business also, one or two guys will figure out a better way to do that, which is why HDFC Bank and Kotak Bank get done well. But please understand this. No, this game is an unfolding game. The great companies in banking can evaporate in no time. Yes, Bank was a great bank. I mean, if I told this to people that, look, one day it's going to be 25 rupees, people would have laughed at it. So things change very quickly in banking. Let's keep our fingers crossed. Kotak and HDFC Bank are great banks, and as I said, we have picked HDFC Bank 25 years back. Been a terrible, terrific returner for us. Bajaj Finance, again, great management. I mean, I think Bajaj Group, in my view, is the best management in the entire country. I mean, they run every business very well. But that's not a stock that, let it bounce back, and I think it'll bounce back and all that. But I mean, given the large-scale damage to job market, to employment prospects, that's not a space where we want to be. Again, view as of right now, subject to change. But there are easier ways to make money right now. Also remember, in our approach to investing, it is never a all or nothing. So when we bought oil, we were cognizant. It's a difficult and a tough call. We liked it. How much did we buy? 2.5%. That's it. We had only a 2.5% allocation in our global funds. That's it. We will never go and put 25% in. No way. So 2.5% has become 4% or 4.5%. We are happy. We will never go all in and all out. That's not our style and our strategy. So if you like Bajaj Finance, please go ahead. But don't put all your eggs into a basket, which is a problematic basket right now.
Sure. I think a number of questions came out. There's now a couple of them on stock level. I'm not sure we can take that, but there was also one series of questions around mid cap and small cap stocks are trending. What is your view?
Okay, so mid caps collapsed after 2017. They had a great run. Also remember this. So we like to extrapolate from the previous year's returns, and one of the reasons why we became very careful this year, apart from we have a huge cockpit of things we watch, built over literally 25 years, amazing number of indicators, model systems, everything. And none of this comes out of just one brainwave one day. I mean, a lot of it is really speaking process. But one of the very simple things is last year was a blowout year for global equities. It was not so for India, but for global market, it was an absolute off the charts returns. Okay, as I said, even continental Europe gave 25-30%. Brazil gave 35%. Russia gave 50%. When you have a year like that, automatically we become careful, because usually, not always, usually 2 back-to-back solid years are very hard. You should be careful. We were careful for that one reason, apart from all other reasons. So therefore, when we exited 2017 with a 65% up year in the mid cap, in the small cap indices, we were careful. And then the LTCG was imposed, I think, in 2018 January end or something, right? That was the trigger. You knew that this sector is going to get crushed. So again, 67% up year, hard to imagine it will have another 30-40% up here. Probability is going to have a down year. And it ended down. 2018 was down. 2019 was, I don't think it was, I think it was flattish down. 2020 has been terrible. So overall from peak to trough, it was down 50%. When you're down 50%, there is a decent chance that there will be a corrective move up, which is what we are seeing right now. And I do believe that there is still upward momentum available in small caps versus large caps. So right now the tactic has to be a little bit different, again subject to the caveats that I just mentioned. But we like them. I mean, and I've said it publicly that at least we like them. We have repositioned our portfolio. Now we have I think 50-60% in small caps, which was very different going into the crisis. So again, it's very tactical as far as we have no fixed great high degree of conviction that this is it and we will never change, even if the market is telling us we should change. So we have rebalanced the portfolio in favor of not trash small caps or mid caps, good quality ones. Hopefully we will do quite well in that, and so far it looks quite okay.
Yeah, I know that we don't normally take stock questions, but you can choose to decline. This is one which is specific on Reliance Industries, and the question is the transformation of Reliance Industries into a digital company for real?
So I mean, the disclosure, we own Reliance, so obviously we like whatever we have seen, hence we own it. Without getting into the stock price itself as a business, I think what Mukesh Ambani has done is phenomenal. And just to put in so much capital, takes a lot of guts. I mean, just to have put in $40-50 billion hard cash over 10 years. I just think what he's created is phenomenal. And there's literally no competition to this. So whether that's good or bad, that's another matter altogether. But as stock investors, we are not in the morality business. As I said even earlier, that's somebody else's problem. So we like Reliance, and we think this whole move away from old economy to the digital will pay dividends for sure.
Yeah, the other one, moving into a slightly different tangent in these next couple of questions, before we close. One is, Ravi says you shared the success stories. Any interesting failures where you learned something from?
Yes. So my single biggest failure or mistake was in 2009, April. Okay, wherein we got the 2008 fall perfectly. It was crystal clear 2007 end that look, this rally is over and we are headed for a very tough time. And that played out very well 2008, even 2009 first quarter. All the indicators that we watched told us in April 2009 that things are turning. It was time to, go long, buy aggressively. But what happened was, dear friend of mine, who is now the second richest man of India, called me and said, what are you doing? And I said, nothing. He said, come, we are having a party in one of these restaurants in Bombay. And obviously, we all from the stock market brethren, we gathered together once in a while. He said, let's discuss how the markets are looking and what needs to be done. And I went there. Usually, I don't attend parties in which stock market is discussed because that kind of corrupts my thinking. That brings your heart into play instead of your mind and your systems into play. But, I was rich. I was feeling good. I got the trade right. I was overconfident. I went there and everybody in that party said this market is, at the Sensex was 8,000, that this market is going to go down 50% from here. It is so bad. While all our indicators that we watched had told us it's a buy. But that one party cost me a huge amount of money. I should have turned. I did not turn. I turned 3 months later. I'm turned only in the month of June. Even though I should have turned in the first week of April itself. It was a huge mistake, and I kicked myself that why did I listen to people? Why did I let opinions of people turn my mind? Instead, why should I have only stuck to data and our systems and our models? I should not have listened to other people. But hey, we are all human beings. We get exposed to a lot of opinion, which is why today I don't have a TV connection at home, just for your information. And I attend very, very few parties.
Another question, is FG de-risked from dependence on you?
I don't matter. As I said, our whole traditional model of investments which was one person or two people thinking, deciding, etc. You know, that is yesterday's model. Our model, as I said very clearly, has become extremely data driven over the past several years, and it continues to become more and more data driven. So my role in FG, or Devina's role in FG, is now limited to only the broad, very apex level strategies. And most of the time that's not even required. It's only required in very extreme situations. Otherwise, you will be surprised if I tell you this, that we hardly spend, you know, hours and days thinking and discussing and looking at markets. It is more like you are sitting there, you have everything there. As long as things are as per what they are, your intervention is minimal. So actually speaking, you know, I have a lot of time, to be honest with you. Lots and lots of time. Much more than, you know, in the last 25 years, when it was very, very personalized, and you to meet companies, discuss, spend time with promoter, wine and dine with them, understand what they were going to do. All that is over. We don't do that anymore. It's not required. It's a waste of time.
Yeah, there's one, and you know, it's coming just now, so let me take it up. How do you think about position sizing with stocks, like your experience with Amazon from the early stage, and as they grow sizably in the portfolio?
That's a good question. Very, very, very good question. So the way we do position sizing right now, we're very different from when we bought Amazon. It was very stupid to have put in so much capital in. In hindsight, we would never do that. It was risky, it paid off, so you know, it made a lot of money, so that's all fine. But that's not really what I recommend. You know, a trade that works out well, having taken a lot of risk, is not necessarily a good trade. You may have made money, but that's not the right process. The way we do position sizing is that we have a preset limit on how much capital we are prepared to lose on a certain position. Okay, and to arrive at that amount, we basically do volatility adjusted position sizing. So that's our, you know, systemic approach to position sizing. So a higher vol stock obviously will have a lower weight, and a lower vol stock will have a higher weight, because in both cases we have equated the amount of capital we are prepared to lose on that particular position. So it's a very, very system driven approach. Even our risk management, which is again part of the process of position sizing, extremely process driven. There is no human intervention here. So we have preset limits based on trading histories, based on a lot of the data sciences we have done for every single stock in our portfolio. And there is no human being in the company who can say, no, let's wait, it'll become even more attractive at this price, you should buy more. Sorry, trade is out, it's finished, forget it. So like I said, there is really no dependence on any individual. It's a large part of it is basically just your processes and systems. It's a man plus machine model. It's neither a man model nor a machine model. It's a combination. And as I said, that's the future of the investment business. So the position sizing, and by the way, we will rarely have anything which is more than 5% of our portfolios. Rarely. If it grows into a 10% position, we will obviously then trim it, for sure. But nothing will start out being 10%. Nothing will actually start out even being 6%. Usually it will be 2.5% to 4%. That's the broad range based on the wall adjusted position size.
Definitely, I think some of the technology guys will be very happy to see the amount of technology used. Okay, the number of operational questions that came in, and I'm not taking them up. Feel free to message us, because they are on products and how to invest in what are the funds, etc. So yeah, we can take those on separately. There is so I will end in one of the interesting question that somebody asked. In fact, Anil, who asked the same question on the sizing of stocks. Okay, he asked, Shankar, what brand of Cafe de Artisan do you drink?
I will pass that question. I was just drinking that right now. So
okay. So
we come back to the technology part. So over the last couple of years, we've made huge investments in technology. I mean, the server cost that we have right now is massive. That's the level of computing power that we put to work every single day to analyze, to really process mountains of data, which is structured data as well as unstructured data. So today, our systems read conference call transcripts, they read social media, they read newspapers, which is unstructured data, balance sheets, etc. That's already done and dusted. We have figured that out. But how to figure out what management's tone is? Are they optimistic? Are they pessimistic? Are they trying to fudge? Are they trying to fool you? All that we have coded, all that we have tested, all that is in process. It's gone beyond the pale of just putting ratios into a machine and the machine spits out a certain list of stocks. And we have got some very, very bright people. We've got a team of the guy who heads this is a IIT Kharagpur topper in comp science. I am from MBA from IIM Calcutta, and around him the team of we've got I think about 4 or 5 mathematicians. We've just hired several engineers. That's the team. It's based in Calcutta. We are building a really cracked level of financial scientists, if I can call that term, because that is the future of this business. This whole traditional HDFC mutual fund and ICICI mutual fund model of one guy sitting, understanding, that's all rubbish. And look at the returns. They don't add up. There are no returns. Look at performance of HDFC mutual fund 10 years. Pathetic. I mean, what's the point of saying that I'm a star fund manager when the numbers don't match? Which is why you have to remove yourself and your biases out of it and let the machine do 90%. You come in right at the apex for the 10%, which is the future of this business. So I'm just letting you know, because you're from Bangalore, you will understand what we are doing here.
Yeah, so that is definitely man plus machine. Shankar, thanks a lot. I mean, do you have any closing remarks? And then we can just.
No, it was a real pleasure, Anil. Thank you for putting this together. And like I said, I have a lot of time. So thanks to the man plus machine model. Trust me, I mean, I'm not making it up. It is liberating and obviously very profitable to do this, because the old style was so labor intensive. I cannot, when Devina asked me, what the hell were we doing? We're running around Hyderabad and Coimbatore and Cochin and Gurgaon and Delhi. We're doing hundreds of kilometers every day. And yet the strike rate is going to be pathetic. So what is the point of doing that? Today information is available. Use that. People are still doing it the way that as if information is not available. So we have moved on. Most of the people have not moved on because they're still set in the 90s way of doing things, which is why I have so much time, And again, if you make money but you don't have time, then what is the point? So that's my message to you. Use technology. Just freed us up in a lot of ways. We are able to do things now in the lockdown which we couldn't even imagine. It's good, and I'll be happy to take any more webinars at later points in time. Any process questions, Anil, please, that's a very straightforward thing which our people can deal with on the account opening, onboarding, etc. But thank you very much for all being there on this Saturday afternoon. It was a real pleasure.
Yeah, thank you, Shankar. It was definitely an engaging session, and I'm sure. Thanks for your offer that to come on again sometime later. I thank all who joined this webinar, and thanks for your time.
Thank you. Thank you, guys. Bye.
Today, Mr. Anil Rego is one of the most well-known financial advisors in the country.